All right, let's dive right in. We're going to unpack a massive deal that's got everyone talking. It involves your money, one of India's biggest corporations, and a huge political debate. We're talking about LIC, the Adani Group, and a 5,000 crore rupee question that honestly needs a clear answer. And this is really the heart of it, isn't it? The question that's been splashed all over the news. Is the money you pay for your life insurance policy actually being used to fund the Adani Group? Well, to get to the truth, you've got to follow the money. And the story really kicks off with this number right here, 5,000 crore rupees. It's just a staggering amount, and it's the scale of the single transaction we're focusing on today. So, here's exactly what went down. Adani Ports put out its largest ever domestic bond, and the state-owned LIC, well, they didn't just buy a slice of the pie. They bought the entire thing, lock, stock, and barrel. Okay, so how does a deal like this even happen? I mean, how does a company go about raising 5,000 crores, and why would an insurance giant like LIC be the one to foot the entire bill? It all comes down to a financial instrument called a bond. What LIC actually bought were something called non-convertible debentures, or NCDs. The easiest way to think about it is like this. Adani Ports needed a really big long-term loan, but instead of going to a bank, they issued these bonds. LIC snapped them all up, basically becoming the lender, and in return, they get a fixed interest payment over a long period of time. And here you can really see the logic, at least on paper. For Adani, it was a pretty smart financial move, right? They get this new, cheaper 15-year loan to pay off some of their older, more expensive debt. And for LIC, their goal is to lock in a stable, long-term investment that's going to give them steady returns they need to pay out policy claims down the road. Okay, but a monster investment like this, it naturally brings up the most important question of all. Is your money safe? Let's take a hard look at the risks involved. You know, when you're assessing risk, the key thing is concentration. Is LIC putting way too many of its eggs in one basket? Just how big is its total investment in the entire Adani Group compared to, well, everything else it owns? And the numbers here, they really put things into perspective. That 5,000 crore figure is huge, no doubt. But LIC's total investment in the entire Adani Group is actually less than 1% of its total assets. The other 99%, that's spread out across a massive diversified portfolio, government bonds, other big companies, you name it. But it's not just about diversification. There's another critical layer of safety here, the solvency ratio. Just think of it as a capital cushion. The regulator says you have to have a ratio of at least 1.5. Well, LIC is sitting at around 2.0, which means it has a pretty substantial buffer to absorb any potential losses and still protect its policyholders. And then, on top of everything else, you have the ultimate safety net, a sovereign guarantee. It's literally written into the law. The government of India itself backs your policy's fundamental promises. So no matter how any single one of LIC's investments performs, that guarantee is there. So if the direct financial risk to your policy seems pretty low, then why on earth did this deal ignite such a political firestorm? Well, this is where the story gets a whole lot more complicated. The core criticism, and you've heard this a lot from opposition leaders, is this idea of cronyism. The argument being made is that LIC, which is a state-owned company, is using the hard-earned savings of millions of regular Indians to prop up one specific corporate group. It suggests the link between business and political power that makes a lot of people uncomfortable. Now, the counter-argument from the Adani side is all about market fundamentals. They're quick to point out that Adani Ports has top-tier AAA credit ratings from domestic agencies. So from their perspective, this isn't a bailout at all. It's a sign of the market's confidence in a financially sound and healthy company. And this is why the controversy is so much bigger than just one deal. It's forcing some really tough questions about our entire financial system. People are asking for more transparency, debating if the government has too much say in how public funds are invested, and questioning whether the rules need to be tighter. We've gone through the deal, the risk, and the heated debate, so let's just boil it all down. At the end of the day, what is the bottom line for you? Let's break it down. 4 key takeaways. 1. The deal is very real. LIC bought the whole 5,000 crore bond issue. 2. The immediate financial risk to your policy is low thanks to diversification and LIC's strong capital position. 3. Your ultimate safety net is that sovereign guarantee from the government. But 4, and this is a big one, the debate around governance, transparency, and political influence, that is far from over. So how do you stay on top of this? Well, keep an eye on these 4 things. Watch for any shifts in Adani Port's credit rating. Look for any new disclosures from LIC about their investment policies. And of course, follow the official updates from SEBI's investigations and any related legal action happening overseas. These are going to be the real clues as to what happens next. And that leaves us with the central question. Was this simply a prudent investment made by a savvy financial institution? Or is it a warning sign of a much bigger issue where public funds and private interests are getting a little too close for comfort? As we've seen, the answer is anything but simple.